Hey everyone, welcome back to Corporate Decoder. Today, Prologis Incorporated just filed its quarterly report for the 30th of June 2026, and I'm seeing some interesting trends in their real estate operations. Quick note, this is not financial advice, just my take on public filings for educational purposes. Prologis is a massive player in logistics real estate, and their latest report gives us a peek into how they are performing in the current market. Let us dive right into the numbers, starting with their balance sheet. At the end of June 2026, Prologis reported total assets of over $101 billion. That is a huge number, folks. Most of that is tied up in their real estate investments, which stand at a staggering $97 billion before accounting for accumulated depreciation. After accounting for depreciation, their net investments in real estate properties were just over $81 billion. This is the core of their business owning and operating warehouses and logistics centers. They also have over $11 billion in investments in unconsolidated entities, meaning companies they partner with but do not fully control. This is a key part of their strategy for growth and managing risk, especially internationally. Now let us talk about liabilities. Prologis carries a significant amount of debt totaling over $36 billion. This is typical for real estate companies that use leverage to finance their massive portfolios. On the equity side, Prologis Incorporated stockholders' equity is substantial, reaching over $53 billion. This includes common stock and a significant chunk of additional paid-in capital, which is essentially the money investors have paid for shares above their par value. They also report non-controlling interests of nearly $4.4 billion. This represents the portion of ownership in consolidated entities that does not belong to Prologis Incorporated. Moving on to the income statement for the 6 months ended the 30th of June 2026, Prologis brought in revenues of nearly $4.7 billion. Their main revenue stream comes from rental income, which was over $4.3 billion. The strategic capital segment, which involves managing their partnerships, brought in over $400 million in revenue. This shows how important their venture business is. Rental expenses were just over $1 billion for the same period. Then there are general and administrative expenses, depreciation, and amortization contributing significantly to their total expenses. Their operating income before accounting for property sales was almost $1.8 billion. What is really interesting is their gains on real estate transactions. For the first half of 2026, they reported over $300 million in gains from selling investment properties. This indicates they are actively managing their portfolio, selling off assets, perhaps to reinvest or to capitalize on market conditions. All of this led to a consolidated net earning of over $2.1 billion for the first 6 months of 2026. That is a massive profit. After accounting for preferred dividends and non-controlling interests, net earnings attributable to common stockholders were about $2 billion. And this translates to diluted earnings per S-share of $2.18. It is important to note their weighted average diluted shares outstanding are nearly 958 million shares. Looking at comprehensive income, we see a significant positive impact from foreign currency translation gains of over $279 million for the first 6 months of 2026. This means that as foreign currencies strengthened against the dollar, their foreign assets became worth more in dollar terms. This foreign currency movement also contributed to reducing their accumulated other comprehensive loss from nearly $676 million at the end of 2025 to just under $400 million by June 2026. Now let us look at the Prologis LP report, the operating partnership. The balance sheet here mirrors that of Prologis Incorporated because the parent company holds substantially all of its assets through the operating partnership. Total assets are the same, over $101 billion. Partners' capital is broken down here. The general partner's common interest is over $53 billion, while limited partners hold over $1 billion in common units. Non-controlling interests in the operating partnership are nearly $3.3 billion. The income statement for the operating partnership is also very similar to the parent company. Total revenues are almost $4.7 billion, with net earnings attributable to common unit holders around $2.1 billion for the first half of 2026. Diluted earnings per unit are $2.18, with over 957 million units outstanding. The key difference here is how they report equity. For the parent company, it is stockholders' equity with common and preferred stock. For the operating partnership, it is partners' capital with general and limited partner interests. In their general notes, they explain their business. Prologis Incorporated is a real estate investment trust or REIT. They operate through Prologis LP, which holds most of their assets. Their business focuses on logistics facilities in 20 countries, and they have two main reportable segments: real estate operations and strategic capital. The real estate segment is all about owning, leasing, and developing logistics properties. This is where the bulk of their revenue comes from. The strategic capital segment involves managing unconsolidated co-investment ventures. They generate income from these partnerships through management fees and other services. Digging into their real estate details, we see that at the 30th of June 2026, their investments in real estate properties were valued at nearly $97 billion. This includes buildings, improvements, and land. They have a significant amount of properties under development totaling over $2.2 billion. They are actively building out their portfolio. Their debt is broken down by currency. A large portion of their debt is denominated in euros, nearly $11.8 billion. This makes sense given their significant operations in Europe. They have substantial credit facilities and commercial paper programs providing them with significant liquidity. At the 30th of June 2026, they had over $5.8 billion in available credit. This is crucial for managing their day-to-day operations and unexpected needs. Their senior notes total over $33 billion. They have been actively issuing new debt this year with a significant amount of senior notes issued in April and June 2026. The segment information confirms their two core businesses, real estate and strategic capital. For the 6 months ended the 30th of June 2026, their real estate segment generated NOI or net operating income of over $3.2 billion, while the strategic capital segment contributed nearly $225 million. The US market remains their largest by far with over $4 billion in revenues for the real estate segment in the first half of 2026. A key metric they track is same-store property net operating income. For the first half of 2026, Prologis' share of same-store property NOI on a net effective basis was almost $1.7 billion, showing solid growth. This metric is important because it measures the performance of properties they have owned for a while, removing the effect of new acquisitions or dispositions. They reported a rent change on leases commenced during the first half of 2026 of 34.2% on a net effective basis. This means they are successfully increasing rents on new and renewed leases. This is a strong indicator of their pricing power and the demand for their properties. Looking at development, they started 24 new buildings in the first 6 months of 2026 with a total expected investment of nearly $3 billion. A significant portion of this development activity is focused on data centers, reflecting their strategy to expand into digital infrastructure. In a notable disclosure, they announced a potential acquisition of SEGRO plc, a UK logistics giant. Prologis made a significant offer and SEGRO's board indicated they would recommend it to shareholders pending due diligence. This is a major development that could significantly expand Prologis' global footprint. The filing also includes a lot of exhibit information detailing various debt issuances. For example, they have 3.905% notes due in 2041. As with all filings, there are certifications from their CEO and CFO confirming the accuracy of the financial statements. Scroll overall, looking at Prologis' financial results for the second quarter and first half of 2026, they demonstrate remarkable strength. Their rental income remains robust, driven by strong leasing activity and rent increases. The strategic capital segment continues to grow, contributing valuable fee income, and their development pipeline, especially in data centers, shows a clear focus on future growth areas. The potential acquisition of SEGRO is a bold move that, if successful, would significantly enhance their global market position. Despite carrying substantial debt, they maintain strong liquidity and compliance with covenants. The key risk I am watching is how successful their data center expansion will be and the integration of a company like SEGRO if that deal goes through. My biggest concern is always the impact of interest rate changes on their massive debt load. What I am actually looking for is continued strong execution in their core logistics business and successful expansion into higher growth areas like data centers. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.